We might actually be finally seeing a rotation out of the big tech stock names that have been rallying nonstop year to date and into industrials, staples, and cyclicals like airlines and travel names. This means that the bull market could be actually broadening, which means that we have more solid footing going into the summertime if this continues. If we continue to see this rotation out of tech and into things like the Dow Jones, which went up by 2.5% on Friday alone, reversing all of its losses over the past month, we might finally find ourselves in a bull market. Interesting timing considering that, interest rates are as high as they are, but we might be finally entering the honeymoon phase where the Fed finally stops raising rates. And there's usually about a 6 to 9 month delay until they start cutting rates. So a lot of news to go over this week, so let's get right into it. Starting on Tuesday, we had the CB consumer confidence coming in better than expected at 102.3 versus 99 expected. And this was actually down from 103.7 as of last month, which was revised up from 101.3. So this was a small drop in consumer confidence, but it was better than expected. So that means that the consumer is feeling good about the economy going forward in the next year. And then on Wednesday, we had the JOLTS job openings also coming in better than expected at 10.103 million job openings versus 9.775 million expected. And this is up from 9.745 million as of last month, which was revised up from 9.59 million. So a huge jump in the number of job openings month to month, which means that the job market is still very, very hot and the Fed needs to do more in order to cool off the economy. But the Fed members that spoke this week are actually thinking about pausing, and we'll talk about that later, after the Chicago PMI came in worse than expected, much worse than expected, at 40.4 versus 47 expected, and this is down from 48.6 as of last month. So this was a huge drop in the Chicago PMI, which means that business in Chicago is really starting to slow down. And then Fed Jefferson also spoke on Wednesday saying that we need to see more data in order to continue to raise rates at the next meeting. This is exactly what he had to say.
A decision to hold our policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. Indeed, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming.
Interesting that the Fed decides to start to pause now after we have this hot JOLTS job openings. We still have persistent inflation with CPI going up month to month in the year-over-year reading, but they're deciding that now is a time to really slow down, pause rates at the next meeting, and then at the July meeting, they're deciding that they're going to raise rates then. I personally think that it's best to raise rates now and get it over with, but maybe the Fed is seeing something that we're not. Maybe it's due to the credit tightening from all the banks that have been collapsing over the past couple of months, but I'm not sure if that's really had that much of an impact on inflation. We're still seeing the hot inflation even after those banks collapsed. So it doesn't really make sense for the Fed to start pausing now, but that's what they're considering. And Fed Harker ended up echoing the same sentiment, saying that the Fed should skip at the June meeting and possibly not continue to raise rates after that. And the Fed really has a credibility issue. Over the last couple of years, they messed up on transitory, and now they're jacking rates up to 4.5%, 5%. People are thinking that they're over tightening, and now inflation is kind of rebounding over the last couple of months. So if we continue to see that persistent inflation, then they're just going to have to raise rates more at the next meeting if they do end up skipping for June. And then finally on Wednesday, the House ended up passing the debt limit deal, where they ended up suspending the debt limit for the next 2 years so they can basically spend as much money as they want. There's no new number to the debt limit. And they ended up canceling the student loan freeze that's been in effect for the past couple of years, to where now student loan payments are going to resume on August 30th. So that means that there's about an average of $300 a month in student loan debt that people are going to owe, which means that millions of people are going to have $300 less each month to spend in the economy. And then on Thursday, we had that ADP non-farm employment change coming in better than expected at 278,000 jobs added for this month versus 170,000 expected, so almost double what was expected. and this is actually down from 291,000 jobs added as of last month. The initial jobless claims came in at 232,000, better than expected at 235,000. And this is up from 230,000 as of last week. And then the continuing jobless claims came in at 1.795 million total unemployed people versus 1.8 million expected. This is up from 1.789 million as of last week. And then on Thursday, we had the non-farm productivity, or basically GDP, coming in better than expected at negative 2.1% versus negative 2.7% expected. And this is down from last quarter at 1.7%. So productivity is still on a decline. That means that gross domestic product is going to continue to decline as well. And then we had the ISM manufacturing PMI coming in worse than expected at 46.9, barely worse than expected at 47. And this is down from 47.1 as of last month. So small decrease in manufacturing PMI, but manufacturing is still in a slump as of right now. And then you had Lulu reporting earnings on Thursday. Their stock ended up going up about 12% at one point. Lucky me, I ended up taking a call credit spread ahead of it because I thought that, just like every other retail name, they wouldn't be doing well. But whenever you sell $100 yoga pants, you're going to have pretty good margins. And that's what I learned from this earnings report. They ended up beating expectations on earnings, beating on revenue. They actually kept their guidance the same as to what Wall Street was expecting. So, of course, their stock ended up going up by about 10%, retracing all of what it lost ever since Target reported earnings a couple of weeks ago. And then on Friday, you had the average hourly earnings coming in at expectations, 4.3% year over year versus 4.3% expected. And this is down from 4.4% as of last month. And then the month over month reading came in at 0.3% versus 0.4% expected, down from 0.4% as of last month. So slightly worse month over month, but the same whenever it came to the year over year reading. And then the non-farm payrolls came in much better than expected at 339,000 jobs added for this month versus 180,000 expected, up from 294,000 jobs added as of last month. And then finally, the unemployment rate has started to go up just a little bit to 3.7%, up from 3.4% as of last month, and this was worse than expected at 3.5% expectations. So now it seems like the continuing jobless claims is starting to actually reflect in what we're seeing for the unemployment rate, to where we might be seeing 4% in the coming months. If we do continue to see this hot unemployment number, then maybe the stock market will finally reel back. But right now it's just at 3.7%, still historically low, which means that the stock market has room to keep going up, especially if the Fed decides to pause for right now. So that's what happened last week. And then for the upcoming week, we're going to have a lot of data coming out on Monday with the S&P Global Composite PMI at 9:45 a.m., where it's expected to come in at 54.5 versus 54.5 for the month of April. And then the services PMI is expected to come in the same as well at 55.1 versus 55.1 as of April. Factory orders is coming out at 10 a.m., where it's expected to be positive 1.1% versus 0.4% for the month of March. So if factory orders is going up, that means that producers will be producing more, which will help to bring inflation down if this number comes in better than expected or at expectations. And then also at 10 a.m., you're going to get the ISM non-manufacturing employment, where last month it ended up coming in at 50.8. And then the ISM non-manufacturing PMI, basically services PMI, kind of, sort of, not really, where it's expected to come in at 51.8 versus 51.9, a small drop expected for the month of May. Not really much data coming out this week, but then on Thursday, you're going to get the continuing jobless claims at 8:30 in the morning, as well as the initial jobless claims, where the initial jobless claims came in at 232 last week. And then the continuing jobless claims came in at 1.795 million total unemployed people. And then for earnings this week, just watching a couple of stocks, DocU and NEO. DocU is going to be reporting Thursday after hours, where they're expected to see 60-cent earnings per share, which is a huge improvement from last quarter at only 7-cent earnings per share and up from negative 12 cents a year ago. So they're expecting a really big improvement for the year-over-year reading. And over the last 8 quarters, they've done an average of 15-cent earnings per share. Now, they have done 60 cents before, so this wouldn't be a record, but this is much higher than it was last quarter and a year ago. So I would be kind of surprised if they do end up beating their earnings per share. And then revenue is expected to come in at $641.8 million for this quarter versus $659.6 as of last quarter. and $588.7 million a year ago. And on average, they've done $577.8 million in revenue each quarter for the last 2 years. NEO is going to be reporting earnings on Friday in the pre-market, where they're expected to see negative 22-cent earnings per share versus negative 51 cents as of last quarter and negative 18 cents. So a small decrease year over year, but an improvement from last quarter. And over the last 8 quarters, they've done an average of negative 34-cent earnings per share. So historically, this will be a little bit better than expected. But considering that NEO is a high-end brand in China where the economy is really starting to slow down, it will be pretty hard to do better than average. So I think that NEO could miss on their earnings per share for this quarter. And then their revenue is expected to come in at $1.69 billion versus $2.33 billion as of last quarter, $9.91 billion. So this is a steep drop year over year is what's expected. And over the last 8 quarters, they've done an average of $3.75 billion in revenue. So Wall Street is expecting much less revenue than they were a year ago and just barely worse earnings per share, which doesn't really make a lot of sense, but we'll have to see how the report ends up coming out on Friday. So that's the earnings for this week, and then the technical analysis for SPY. It's expected to be in a range between $420.80 and $435.20, or up or down 1.7% for this week. We've got supports at 425.50, 421.22, and 418.21, as well as resistance at 430, 431.73, and 435.12. Right now, the RSI is at 66.5, which means that we are getting a little bit overheated, but that's actually signs of a strong bull market to where this could continue if we continue to see the rotation out of technology and into the cyclical names. So looking into ETFs like XLP, XLU, XLE, the ones that have been beaten down over the last year, these might end up recovering to where you might see some gains for SPY because the bull market is broadening. So that's for SPY. And then for DOCU, the earnings that I'm watching for this week, their expected range is between 49.60 and 65.40, or a move of 13.7% in either direction. So a huge move expected, with supports at 55.28, 54, and 50.33. as well as resistance at 58.75, 61.50, and 63.93. Right now, RSI is at 67, so we're almost getting overbought, but that means that there's a strong trend going into the earnings. So if they do end up beating their earnings, which I don't expect, and they beat their revenue, their stock could be above $63, or the high end of the expected range. If they beat earnings, miss revenue, I expect their stock to still be above 60 because the trend's going to continue if they beat their earnings per share, which is extremely high. But if they miss their earnings per share estimate and they beat revenue, I expect their stock to be above 54. And then finally, if they miss both earnings and revenue, I expect their stock to slip below $51 towards the bottom end of the expected range. And then for NEO this week, it's expected to be in a range between 560 and 860, plus or minus 13.2%. So another big move expected for NEO this week, as well as DOCU, with supports at $7.33, $7, and then resistance at 760, 814, 830, and 858. Right now, the RSI is at 42.6, so slightly weak, but not extremely. And the stock has been in a steady downtrend since the beginning of the year. So if they do end up beating their earnings at negative 22 cents and they beat their revenue at 1.69 billion, their stock could end up actually starting to rally again above $8.25. If they beat earnings, miss revenue for the quarter, then the stock would be above $8, I think. If they miss their earnings, beat their revenue, I expect their stock to be above $7.40. And finally, if they miss both earnings and revenue for the quarter, I expect their stock to be below $7.10 by the end of the week. So that's my technical analysis for y'all. Hopefully this video was useful. If it was, show some love, leave a like. Thanks for making it to the end, and thank you to all my patrons and my channel members for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.